Hey there, welcome to the channel. So today I want to do something a little different. What I want to do is I want to do a fundamental analysis of Shift Technologies. So this is one of those stocks that I know at one point me, Kevin had, he kind of watches it. And I don't know if he's actually has had it recently or anything like that. But this is one of these up and coming kind of new business model companies for how you sell cars, et cetera, that type of thing. And looking at the chart here, we see that it's been utterly obliterated. This thing is, looks like it came public in the $10 range, and now it's at under $2. So I want to take a look at the fundamentals and kind of see what's going on with that. Okay, so here we go. So what I did is I went to Shift Technologies website, and there what you have is you can get the financial data. So basically they have where you can download the financial data for each quarter. So what I did in this case is I just took the last 3 quarters of financials and put them all together on one spreadsheet so I can do some comparisons. Now, what happened was in the 2020 data, it looked like the format was different, so I didn't use that data. But this should give us a good idea of what's going on with this company. So first one I want to look at is the income statement. So first of all, is this a high flyer? Is this one of these companies that has a lot of growth? Well, let's check that out. So here we have the income statement. And so what you have is we have for the last 3 quarters going like this. So we can see that our revenue, our e-commerce revenue, it's broken up into e-commerce, other, and wholesale. Looking at the overall revenue, the sum of all that, you can see that the revenue is going up. We're at, these numbers are in thousands. So this is 106 million to 154 to 179. So if you look at that and quarter over quarter, you see that you had growth here in June of 46%, but then that did slack off to 16% on the latest quarter. Now, because I'm doing quarterly data, you have to be careful because there could be seasonality to this. So you just want to take that with a grain of salt. But that's not really the focus here is the revenue growth. There is revenue growth, but that's not what I'm kind of focusing on. So you do have to take it with a grain of salt. In other words, it could be that in that September quarter, it could be that the sales are always much lower. And hence, so this growth could be a very good thing, right? It could be seasonality where some quarters they have less sales than other. And to do that, you would compare the quarter over quarter. And in addition, you can compare the annual over annual. So for right now, we'll just go with this. But you can see that there's some growth here, right? So we do have what you call revenue, which is sales increasing. But here's where we start to see what maybe the issue is. Cost of sales are very high. So what I'm doing is a vertical analysis. So what I do is I take the components that I'm interested in, and what I do is I look at them as a percentage of the total revenue. So over here, if I want to look at cost of sales, which was 166 million, and I want to get a sense for how much that was of the total revenue. So what I can do is I can go up here and say, look at, I can take my cost of sales and divide that by the total revenue. And that will give me as a percentage what my cost of sales is. And that's what I've done. And I've done that for all the quarters so we can see how it's changing over time. And then also do that for the gross profit. So really simply, your revenue here is a number. And the things that they sold, cars in this case, it cost them. So for example, if they sold a $10,000 car and it cost them, $9,000 for that $10,000 car, then they would have a 90% cost of goods. And then they would have a 10% profit. Okay. So in this case, what they have is their cost of sales overall are 93%. That means that their gross profit is only 7%. So what's going on here? And you can see that it was 7% here for gross profit. And then it improved in this quarter to 11%. Okay, that's good. But you can see that there's a very thin margin there. So remember that does not cover anything else, your operating expenses. So now we have to go to our SG&A, selling general, et cetera. So that's for your rent, that's your employee salaries, that's everything else in operating that business. And what we see here is like, gee, that's 32% of your total revenue. That amount is what it's costing. So hence, if we have 32% in expenses and we only made 7%, what do we have? We have a loss. We're losing 26%. So here's where the thing is going on with this. This is where I see the problem. And now I understand why this company is being sold, sold into the grave, and where I honestly wonder if it can make it. See, the problem is that you have a thin margin up here. You only got, between 7 and 11% gross margin to work in and work with. And the result of that is that you don't have very much profit to support your selling and general expenses. So here, what's going on is they have a very high cost as a percentage of their sales. They're spending a lot of money, and it's causing these net losses. So that's where the problem of this company is. And so if you were to look at this company and say, what would we look for improvement? Would you be looking at sales? Well, sales is one thing. You would hope that they continue to grow their sales. But the other thing is you really have to look at this margin, because I did an experiment over here. I just said, well, what if we take the total revenue, we say 10x it. So let's say a year from now, they 10x that revenue. Okay, great. But if they don't change their margin, they're in the same position. Nothing changes, right? If they don't get more margin, if their SG&A grows by 10x as well, then they're in a really tough space. They're no better off. They're just losing more money at a larger scale. Now, the goal, of course, would be to basically get in a situation where maybe their SG&A only has to grow half as much. So let's do that experiment. And then you can see that, okay, it's a little better situation. They're only losing 9%. But this is a huge challenge. So think about it. You have to take what I just did here is I reduced I said the sales grow at 10x, but the SG&A only grows at 5x, at half the rate. Okay. And that would possibly be a very optimistic scenario, but they're still losing money. And why are they still losing money? Because they don't have the margin. So the key things for this company are not growing into new markets, not growing sales, because the sales they have are non-profitable. They're not making enough margin. So the keys are they have to make more margin. They have to improve this margin number. And then they also have to hold the line on their SG&A. That's what they have to do. The other thing is, well, where's the money coming from? So the other thing, when you're looking at a startup company like this, you really want to watch like, hey, how much cash do they have? How much cash are they burning? And what do they have left? So what I did here is if you look at the cash flow statement, you can see that the net loss, they're going to have to resolve this. You have these net losses and you have to resolve like, well, where did the money come to support that? And probably the key line here is proceeds from the flooring line credit facility. And you can see that it's growing. What they're taking is growing. Here was 57 million, 162, 227. So they are really drawing on that. And if you just took this quarter, they're saying they drew down $227 million from that credit faculty. Let's go look at the balance sheet. So if we look at the balance sheet, you see your cash equivalents are 176 million, 238, 247. So what you're seeing is that they do have their cash growing, but where is that cash coming from? Well, the cash, it turns out, is coming from the proceeds of the flooring. So here I've plotted the cash in blue. So here you see the cash is growing, but you also see that they're drawing that cash from the credit facility. So they're basically borrowing it. So this is actually, the $100 million is almost irrelevant. It appears to me, and this is not financial advice, but they're really in big trouble, because if you look at their cash flow and you see that they're burning 200 million a quarter, and they only have 247 million in cash equivalents right now, even though they got $100 million financing, that doesn't buy you a lot of time. And the main issue with this company is they don't have enough margin here. So I think that this is an interesting thing. If you've ever watched like Shark Tank, you will see them just rip someone apart who is like, has one location or one product and is talking about expanding, and they want to expand to another product or expand to more locations. And they will rip them apart when they're like, hey, listen, your current location is not profitable. You can't scale something that isn't profitable. If it's not working now, how do you think making something that's not working bigger is going to work. And that's exactly what it appears to be Shift is doing here, because this is not working. And I would now even speculate that their entire model is not going to work. It's not going to be a profitable model. Well, why? Because look at their cost of sales are huge, and it's so huge that their SG&A doesn't cover it. And their SG&A is actually very, very high. So if I look at it and say, hey, if I'm gonna like have people go to your house so you can test drive a car and do all that stuff, and I'm gonna make it really easy for you to buy, sell a car, but you're going to have people running around with like chicken with their heads cut off, like driving cars around for people to go do test drives. Like, how efficient is that? It's not very efficient at all. It's actually like, that's probably what we're seeing here. We are probably literally seeing that this business model is not going to work because it's too expensive to offer that kind of service. You have no margin left. You have very little margin for starters, and then you have so much in expenses to run the business that it's never going to be profitable. So that it really is what I see when looking at this. So one more thing that I want to talk about is that you can do this yourself. All this data is publicly available. You can go to whatever company you want, and they will have these in download formats. So you can grab the financials, you can grab them and put them side by side. Now, this is how I like to do it, because I like to, and ideally I would have added a couple other quarters, but they sort of changed the format and I didn't want to waste my time with it. But you can do this yourself. And this is actually a really good thing to do. This is called a vertical analysis over here. You basically figure out, well, cost of sales, what percentage of sales is that? What was that cost? What is a gross profit? This is hugely important, because your gross profit, if that's low, then you don't have room for your SG&A. And then your SG&A, well, what percentage is that? What percentage is that of your sales? And you can do this and you can get your own feeling for a company, like how profitable they are. And then you can get a feel for like, oh, they're growing, oh, they're expanding. And you can get a feel for whether that's a good thing or a bad thing. And you can also, what you can see with things like SG&A, notice that it was 47%, then it went to 31% and 32%. So there was a little bit of a positive trend back here. You can see that as a percentage of sales, they were able to get more sales in the June quarter without really increasing the SG&A. And they were able to get more sales again in September without increasing the SG&A as a percentage. So that is a positive sign. But they got a long way to go. They're going to have to grow this top line a lot. They got to get some more margin here, and they got to really hold the line on this. If they don't, they will just never be profitable. So as I was saying, I think their business model may be problematic. And then there's competition. You have Carvana, you have all these other ones. And then are they really doing anything that your average Joe car dealer can't do? Can your average Joe car dealer be like, yeah, ma'am. Yeah, sir. Yeah, we'll bring the car over. Yeah, just like, you're interested in this car? Okay, we'll have a guy drive it over. Like, there's no moat. The concept of a moat, where's the defensible moat? Compare it to something like, what's Amazon's defensible moat? Amazon, what's the defensible moat? Well, okay, you want to get into the business and compete, invest billions of dollars into everything from infrastructure, warehouses, Amazon Web Services to run all the online stuff, and the experience, the reach, it's billions and billions and billions of dollars just to get in it. What is the moat for getting into, let's say you want it to be Apple? Okay, well, gee, where is Apple now? Not only are they vertically integrated within their company in terms of they got total control over their supply chains, and they're designing all their own chips, all their own stuff in there, and all that stuff is billions and billions and billions of dollars of research and development just to come up with your own thing. So that's a very big defensible moat, right? What's the defensible moat here? Nothing. If I'm Emerald Motors, this is a little like car dealership back in Connecticut. Like, if I'm this guy, like, what's to stop me from being like, look, I can improve my website. I can help people out. Like, hey, Joe, take the car over here to this person, just, check their ID and we're good. And they can offer a lot of this stuff. So now I get it. Now I really do understand why this stock is being sold into oblivion, because they really, this is not financial advice. This is my opinion. I think they're really in trouble. I think that they are burning a lot of cash. Scaling the business doesn't solve their problem. They got to get more profitability. And I just don't see it in the numbers. All right. Well, that's it for this one. Bye.